And in order to make generational wealth, legally, you either need to migrate to America and join part of the AI boom, or, start a roll-up. Hence the name of your podcast, Reprise. I've received more inbounds from investors looking for HVAC and electricity contractors and plumbing in the last 2 months than I have in the previous 3 years. Everyone's piling into those skilled blue-collar industries. Every conversation with an eligible founder needs to start with, what is your dream? If you are selling yourself as the successor, as the l'héritier of that business. If you're good in convincing these people to sell to you when you don't have any money, imagine how good you're going to be when you do have the money behind you. Now is the time to go and buy your business and to achieve freedom. ETA is freedom.
So you are just pitching me about what has changed in the last years, but how did it all start? Can you tell us again, what were you doing before being involved in rollups?
Sure. So my background is this. I'm 40 years old. I have a background in investment banking, originally from Latvia, a small country in Eastern Europe.
Okay.
Spent most of my career in London working in investment banking. Spent some time working in corporate. So worked in corporate development at a major bank. Worked in corporate and business development at Bolt, a tech company. But truth is, I never really felt at home. When I was in banks, I always felt like, being promoted to managing director was not an objective for me because I didn't feel like this is a particularly inspiring path. When I was in a tech company, I felt like I wasn't going to make it to the very top because it was all just tech people. There were the tech bros and the finance bros. So unaware at the time, I was looking for something that would be fast moving, very entrepreneurial, but also an area where I would have an advantage because my background is M&A and finance. And so I remember having this, kind of like a bitching session with my brother 4 years ago over a beer. And I was saying, look, I'm too old for private equity. I don't really want to work in a corporate. What could I do? And my brother said, listen, you have to join one of those software roll-ups because his professional journey was from Big Four to private equity to Constellation Software to a mini Constellation Software.
He worked in Constellation Software?
He worked in Constellation, yeah,
nice.
as a sourcer. And I was like, and until then, I didn't really think much of my brother's background because I thought, hey, he went from working in private equity to buying those tiny 1 million EBITDA businesses. But then Pavel, my brother, drew it on a piece of paper for me and explained to me in the value creation and compounding. I was like, oh my God, that's a whole universe, right? And so I followed his advice. I talked to a couple of software buy and builds. I ended up landing on one called Threecolts, which at the time had just closed a round, made the first 2 acquisitions. It had $7 million in revenue, did not have a finance function, not really, did not have an M&A function. And I was like, that's amazing. I can be everything. I can be CFO. I can be head of M&A.
So like late founder kind of
thing, yeah.
And like finding the mix between your 2 backgrounds and have this edge that you were looking for, no?
Yeah. I think just for the listeners, mixing CFO and head of M&A is not a good idea. You need to separate those 2 positions.
And mixing, later we can talk about you buy your first company and then do you want to be the M&A guy or the CEO guy? And I've heard in our bootcamp in London that you can't do both. And I think we will need to talk about this because
Absolutely.
I'm doing both now. It's not a good idea. So going back to you.
Yeah. And so I was plunged from a relatively structured corporate environment all of a sudden into the world of very small software companies. We're buying Amazon SaaS applications.
Okay, very niche.
EBITDA range from $500,000 to maybe $2 million EBITDA. People have never done a transaction in their lives. People using divorce lawyers as their counsel. People being aggressively non-compliant with just about every regulation. On the one side. On the other side, I have lenders. As a CFO, I had to sign off every month on debt covenants. I had to make it work. And so this was a lot of frustration, also a lot of discovery. And very quickly, my brother and I started craving for a community where we could discuss those problems, right? We could say, hey, how does one set up an outbound motion? How does one solve, an issue with warranties and indemnities? And fundamentally for me, because I was also on the fundraising side, is that who on earth could invest into something like that, right? And this is how the community was born. In the early days, my brother was also running a bunch of LinkedIn posts, so we repurposed them into a blog post. I remember our very first event was a steak dinner sponsored by JP Morgan. They did not allow us to call it RollUp Europe dinner. It was a JP Morgan dinner, and we invited 10 people, all from software rollups. And that in May 2023 was the birth of RollUp Europe.
Okay, and what was your how did it go with your job? I know the company went from 6 million to 70 with the acquisitions you made in this build-up. When was that? When you became CFO? What happened?
Yeah, so I started advising informally at the start of 2022. Very quickly, it became obvious to me that holding down my job at Bold as the head of corporate development and doing this was not possible. So in February 22, I resigned. I joined full time in May 22. And, in a quick succession, we closed about 20 acquisitions. We raised over $100 million of debt. And then, RollUp Europe started to take off. And so fast forward to summer 2023, it became clear to me that holding down a full-time CFO and head of M&A business in a fast-growing roll-up, a media business and a family was not viable. And I decided to basically go all in on the media business. And at that time, we needed a third co-founder, somebody who could actually do all the operations and just create like a business that just doesn't go bust. And that's where our third co-founder, which is my wife, Helen, joined us. And so today it's the three of us, three founders.
Okay, amazing. But you had like a kind of successful job. It was safe. It was going fast, and you went to a media business starting from zero.
Yeah.
What convinced you? What made it so obvious that you had to like go on this opportunity and basically like spread it with the wall?
For me, 3 years ago, I was coming out of the closet. Not in a sexual sense, but in the sense of I realized that all these years I've been repressed. I was trained. I did my undergrad in economics. I did my finance in economics. I'm a CFA charter holder. I was a banker for a long time. And so I thought that the life that's good for me is the life of a CFO, life of a corporate guy. But all these years I'd been, craving for something that's more entrepreneurial. But when you're in finance, a lot of the entrepreneurial stuff is very scary because, you need to be a coder. You need to be an AI engineer. But the truth is, like, you can also start a media business like that, right? I mean, you know it extremely well. And so for me, I realized that writing engaging content, hanging out with people that want to buy businesses, this is my life, right? And to me, until, I made this decision to quit my job in the summer of 23 on a holiday. And to me, it came very painlessly because I had come to a realization that this is my life. I mean, my family had some concerns. My wife stood fully behind me, but I knew it was gonna succeed.
Okay, and so how is it going now?
Today, we have a newsletter that's read by thousands of people, people that are just starting out, people that are very successful investors managing billions of dollars. We've hosted now 15 conferences in Europe and in the US earlier this year. We've launched the Bootcamp, which you're part of. Uh-huh. So I want to talk about that as well.
Yeah.
And then, we've invested in a number of serial acquirers. And, we're also thinking about potentially setting up a placement business, which helps people raise money.
Okay. And did you see the environment evolve? Like how has the market evolved in like the last 2 or 3 years? You said, you are part of the movement, you are spreading the word.
Yeah.
But did you see it seems like there's a lot of money coming. Where is it coming from? Like, are people like seeing the opportunity? And can you describe this opportunity? Because I'm convinced, but like for people who don't know, how would you describe it?
Yeah, it's day and night between when we started.
It's what?
It's day and night.
Okay.
For me, this is all part of entrepreneurship for acquisition. And for me, entrepreneurship for acquisition is freedom, right? This is what one of the guys in the bootcamp put it to me. He said, I wasn't satisfied with my job. And in order to make generational wealth, legally, you either need to migrate to America and join part of the AI boom or, start a roll-up. And I think what's happened in the last 2 years was basically three main trends. The first one is there's a lot of talent flowing into the space. Right, the same way that there was excitement about crypto, maybe about AI, but the truth is that sort of the entry barrier is much lower. You don't need to have like special training. So we've got people live in private equity, people live in tech companies, people live in corporates. Everyone's really interested, and everyone wants to pursue a slightly different strategy. This is the most important ingredient. Without really cool talent, people wanting to go and buy those companies, create the next Constellation software or Valsoft or like a Visma, it's not going to happen. So that's number one. Number two, as you say, there's a lot more capital. Capital is flowing here because of the success stories, because people are waking up to the fact that actually you can produce, very interesting returns. Not quite venture-like returns, but nowhere near sort of venture-style risk.
Exactly, it's a different risk profile.
It's a different risk profile, right? Like you can produce 4, 5, 6 times net MOIC within a relatively short span of time because you're buying lots of companies. There's obviously value creation, multiple arbitrage, and so we've seen investors that would previously allocate to private equity, mid-cap and large-cap funds very interested in independent sponsors, which is basically deal-by-deal situations, and also the emergence of dedicated funds. You've got Reprise in the US and TELUS North in the US. You've got Shore Capital is the OG in Europe. You've got Strata, Builders Associés, Tangleman. So a lot of dedicated capital providers, they just get it. And I think the third ingredient, frankly, is us. And we talked about this before this pod. Like, why does a media business like RollUp Europe exist? Very simple. 3 years ago, there were super cool venture conferences, but if you're not a venture guy, rocking up to Slash or Web Summit, they're just not interested in you. Like, you're not doing, the hype of the moment, AI, crypto, you get no audience. That's how I felt it, right? But I love the energy. I love the enthusiasm. PE conferences, on the other hand, and a lot of the PE content is just lame, old school, very boring guys in suits, right? And we wanted to take this energy and bring it to the lower mid-market space and make it really interesting, right? And I think it's us. I think it's your pod. I think it's really interesting conferences. And people are just saying, listen, there are now events where I can go to learn about this opportunity. And also I have to thank business schools, because the whole search fund movement has evolved, where 2 years ago it was just search funds, single company acquisition, you just work on it. Now it's long-term hold, now it's roll-ups. So the fact that business schools like INSEAD, Harvard Business School, London Business School are promoting this, been tremendously helpful.
Yeah, I think also the timing, we are all talking about this generation movement where a lot of boomers are saying their company. Do you think it's like now is the right time because of this, or just because people finally started to understand it's a good risk profile? Like, what do you think about this? Is it like marketing or?
Yeah, people ask me, like, haven't entrepreneurs been getting old the whole time? It's not like people are aging faster or slower. Like, so what's happening? It's a really good phenomenon. I think it's down to a couple of things. One is, if we take Italy, for example, right? Italy is a very good market because it's Europe's oldest country, but at the same time has a lot of high quality businesses that just lend themselves well to aggregation strategy, like all this niche manufacturing companies. So what's happened is a lot of these companies were built after World War II. The first generation that built them is gone, right? They've retired or they've passed away. They've passed to their kids. But a lot of their kids just don't want to do this. They're in their 40s and 50s. And I think what's been happening is that a business doing 2 million EBITDA just wasn't going to be sold to an institutional buyer. Private equity is too small. Search funds did not exist. I think now finally, obviously there are many more of these people retiring, but now finally there's somebody to take over a business with 2 million EBITDA. Hence the name of your podcast, La Reprise. There's somebody to actually take over a small business.
Yeah, and I was gonna say, so in our podcast we talk about la reprise, racheter des business, buying like a lot of individuals buying a first business. But I think the level of the opportunity of doing a build up or a roll up is like way higher. Can you tell us about like the unit economics? What's the difference between just buying a business and saying, okay, this is gonna be my project for 5-7 years versus doing my business is buying businesses and putting them together, which is kind of different job.
No, it's a very good question. And I think the first thing that people ask me, what's the best structure? Where can I get the best equity? I'm like, hang on a second. This is the wrong question, right? And that's what we talked about in the bootcamp is we start by asking yourself, what is my objective, right? And I think the first question you have to answer, am I an allocator or an operator? Because if you're an operator, probably buying a single business and maybe adding over time is better, because then you can get your hands dirty with finance, with operations. If on the other hand, you're more of an allocator, the person that's going to get the financing in place, hire people, think about the roll-up. Now, in terms of, value creation, unit economics, let's look at 3 different structures. So the first structure is basically a roll-up where the exit path is ultimately to private equity. Why does this even exist? Because as you know, private equity is an AUM game. So funds want to get bigger and bigger, but that creates a problem when the minimum ticket is 50 million or 100 million or 200 million euros. And so somebody needs to assemble that initial platform with anywhere between 10 and 30 million of EBITDA, right? So you basically analyze the market and see what are the industry that private equity likes. Recurrent revenue, mission critical industries, and you assemble a platform for them to sell.
Yeah. You're instead of thinking as I'm buying this business and the product we are selling is what this business is selling, is no, I'm building a business and the product I'm building is this aggregation, and the client is the private equity fund. It's
that's exactly that.
Prepared for them.
Which is why it's very important to know who is the ultimate buyer, right? This is a very good point. The second strategy is holding companies. So it's a relatively recent phenomenon because only now people are starting to see decades of compounding by Canadian holdcos, like Constellation Software, American ones like Roper Danaher. In Europe, we've got Visma, Lifco, Roco from Sweden. It's a very different strategy where, in a way, there is no exit. Like, in a way, you're selling a product to public market investors and high net worth individuals, endowments. They just want a product that's going to compound by 10 to 20% over very long periods of time. That strategy does not necessarily require you having one specific sector focus, but it does require you having a very large sample of attractive businesses. So asset light, cash flow rich, and basically you recycle cash flow and buy more and more businesses. You kind of create like a perpetual time machine.
It's the Warren Buffett way.
Warren Buffett way. We're also starting to see derivatives of this. So Bending Spoons in Italy is a very good example where instead of buying small companies running a decentralized operation, they're buying lots of very large companies and running a very centralized operation.
Yeah, and this very new, very modern, and very made for our times with a lot of AI, a lot of automation, a lot of debt too.
A lot of debt as well. Yeah.
I mean, it's high risk as high reward. If they keep succeeding, it's going to be big, but it's also like on a high spectrum of risk, right?
Which also brings us to the first structure, which is VC-backed roll-ups. VCs have always liked roll-ups, and my previous roll-up, Threecolts, was backed by VCs.
Okay.
But I think what's happening now, VCs are saying, listen, there's AI have the potential to transform industries X, Y, Z. And I think there are some early data points out there. The truth is, we don't know yet, what type of returns they will deliver, but at least on paper, the argument is very compelling where you can take out the cost of labor, you can automate processes. And fundamentally, there's a technology that you could sell, but the idea is that, look, the adoption curve is just too slow, so let's just go and buy distribution. And that's why you're starting to see so many of those property management roll-ups, accountancy roll-ups, where essentially you're just buying, distribution and you're completely changing the tech stack.
Yeah, and do you think the VC market, especially in Europe, is changing a lot? I mean, it's a question, but also you mentioned that now, if you're not like a Silicon Valley AI-powered startup, you won't be financed. It's like VC now is only one game, and if you're not, it seems to me that if you're in Europe, like the money, the VC money doesn't really know where to go, and that's might be one reason why they're looking for new assets like this.
Absolutely, I think it's like the cynical part of me is also there are a lot of zombie software companies that just struggle to take off, and so one way to reboot them is to say, hey, let's just take the tech that you use and let's start buying a distribution so it's captive clients. TeamShares tried to do this, the early iteration, where the idea behind TeamShares was that there's lots and lots of small businesses in the US that use third-party providers like, JP Morgan for bank, QuickBooks for accountancies. So the TeamShares 1.0, if you wish, was buying lots of those businesses. And the idea was that, they replaced their fintech stacks. It didn't really work out. So now it's a more conventional holdco. So you just need to be very careful as to, if you forget about the financial plumbing, if you forget about multiple arbitrage, the business that you buy needs to be better off for the clients at the end of the day.
Yeah, and since we're talking about AI, it's true that, what do you think what do you think that AI has changed in terms of criteria of what is a good business, what is a risky business, who's gonna survive? You talk about buying distribution. I agree. One of the only things that still has value today is do you have an audience? Do you have clients? Do you have distribution? With a media business, a lot of things are, who knows if it will have value in 6 months. So how has it changed in terms of criteria for you, or when you look at businesses, what is risky, what is not risky, what you would not touch in terms of buying a company?
I think number one change, it's a lot easier for buyers to contact owners. So I think that just makes a lot of generic cold outreach very difficult. So it's much easier for you to compose the initial data set. And so if you just comment generically at, hey, I want to be the next owner for your business, it's just not going to resonate. I think that's number one. I think the second thing that's changed a lot is there's a lot of investor interest in AI-proof industries. Okay. I've received more inbounds from investors looking for HVAC and electricity contractors and plumbing in the last 2 months than I have in the previous 3 years. Everyone's piling into those skilled blue-collar industries. So, we need to go and urgently produce all these electricians. But at the same time, this creates an opportunity for you to go and buy software businesses that, investors think are doomed. But if you think that distribution is stronger, you can build on them. Obviously, there is a lot less competition.
Yeah, now you don't want to buy code. You don't want to buy technology. This is like low barrier to entry. You want to buy clients. You want to buy ARR, I guess,
Exactly.
in software. So you want to talk about the bootcamp? I want to talk, like, maybe it would be interesting for like the audience to be like, okay, if you are someone who's watching us, has been watching it, and want to maybe see if doing a roll-up is for them, what's the typical good profile to get into this? And then what's the step 0?
Yeah. So you know how RollUp Europe was born because we just got annoyed that there wasn't anywhere to go and talk about roll-up. So we created this. Bootcamp kind of had a similar beginning because I do a lot of calls with operators, founders, so people like you and a lot of our listeners, and it's the same questions over and over again. And at one point I was like, is there a button I can just press to answer those questions? And then I was talking to my wife and she's like, well, but why not productize this problem? Because it's a legitimate concern, or not concern, but line of inquiry. What's the best structure? How does this work? What do I need to have in place? And so we created this bootcamp, in Q1 was the first intake, where we said, what is the minimum sort of viable product that we need to create to help people get it off the ground? Because we were solving for 2 issues. One is just people having some very real questions. And the second one, a lot of people hesitate to do this. Is this for me, right? And you just need a little bit of a nudge. And so for us, the sort of 3 things that we needed to answer and give people insight on, I think number 1 is help you decide what's the right structure, what's the right of investor, right? Because if you don't have an AI thesis, don't go to talk to VCs, right? But equally, like, there are certain type of investors that also want you to deploy a minimum of 50 million. If you only want to deploy 5, don't talk to them. So matching people with the right of investors, with the right structures was a top priority. I think the second priority for us was help people get started. Okay, I have a thesis. How do I test it? How do I know if it's a good industry? And part of it is just like going out there and talking to the people in the market and investors, but also what do investors underwrite? Because people ask me, hey, Alex, do you think fire safety is a good roll-up? I don't know, because it depends on the market. But what if we gave people access to investors seeing lots of deals, they'll be able to say, is fire safety neatly a good market right now? Okay, well, maybe there's 20 other people doing exactly the same thing. So being able to validate. And I think the third one was, what does the first 100 days of that look like? And that includes, how do you originate deals?
Yep.
Again, there's no one-size-fits-all recipe, because a market that has a lot of brokers, you have to go and talk to the brokers. Market has no brokers, you have to go and see those business owners. You have to write those letters, right? Like, we want to talk about debt. We want to talk about being able to exit. And so we've now done 2 boot camps. We're going to start a 3rd boot camp in the autumn. Probably the single biggest learning for us was that very few people are ready to pitch after 6 weeks.
Okay.
We realized this, and also our investors realize this. So it's a nudge that gets people on that path. But also it could be that we talk to those boot campers 12 months before they enroll in the boot camp. And maybe there's another 12 months before they're ready after the boot camp. But the important part is that signals the intent.
And maybe some of them will realize it's not for them, or it's not exactly what they're looking for. And I think in 6 weeks, as Helen told me, it's already a pretty good learning.
Yeah.
Because it's true that for me, I was in the bootcamp, like from the outside, like the information is not, it's really hard to have all this info. And inside, it's true that you are structuring all this. It's very new, and you don't have like a lot of blog posts that make it so clear. And okay, what is a holdco? Is this the best path for me? Or if I want to do the roll-up product, well, who is your target? Oh, it's the private equity investors. So you need to have this kind of profile, this kind of market size. So I think it's you have a lot of it's very useful to come in this bootcamp, I think, to understand how the market is structured and see if it's for you.
So something that we haven't announced with this, I'm going to announce in this pod, is that we're actually rolling out a new product, a self-service course. Because ever since we've been building RollUp Europe, it's always been about founders, people like you, right? So for me, what do you need to be successful? And so you don't need to have any money. You don't need to pay anything to read our newsletter. 75% of the content is usually free. So for people to get them in the game, to start even thinking about doing a roll-up or a holdco, here's the newsletter, right? Okay, the next step in the engagement is the conference. We do multiple conferences. We're going to do one in Paris. We have a big conference in London coming up. Conferences. And then we had the bootcamp. But we realized is that a lot of people, particularly in the first bootcamp, do this because they want to hoard information, which obviously isn't great for investors that really want to back somebody. But what if you're not ready? What if you do want to get information? So what we're going to do over the summer holidays, we're going to record a course, a self-service course.
It's not a holiday if you're working.
Well, it's going to be spent in the studio, but that's something that we're very excited about bringing to the community. And it could be that you take the course, on your own time, you realize that it's for you, and then you want to do the bootcamp and meet the investors.
All right. Do you want to talk about the steps of someone who would do the bootcamp and end up like being successful in doing a roll-up?
Well, you should talk about your story.
I mean, as you know, okay, we can talk about. I think one of the main things I've learned, and very quickly, and I think it's one of the things I like to invest, and go directly to the source, and then I save time.
Yeah,
was this thing that we talked about, but two different people talked about. Was like, if you are going on this path of like buying many companies, then you cannot be operator and M&A at the same time. Mm-hmm. And about my first business, and I realized, in my case, it was too small compared to, for example, what you would advise.
Mm-hmm.
And so now I'm kind of stuck in the operation. So it's just a good learning. It's like, okay, if someone wants to do a roll-up, it needs to be big enough, like the market cap and the companies you buy, that you will be able like to pay someone just like to be the best at like operating the company while you're the M&A guy, or do one or the other.
Absolutely. And that's something that we kind of start with is like, ultimately, what do you want to get out of it, right? Because if you want a lifestyle business to run, bootcamp probably not the right thing to you, because there's a bunch of courses, certainly in the UK. How can you buy a business with no money down? Those are not bad courses, but that's not what we teach, right? Like we're like, okay, if you want to attract institutional grade investments, and I think the first question for you is that, why are you doing this, right? Like, are you doing this because you're coming out of another roll-up or a corporate where you see an opportunity? For example, I get a lot of inbound from private equity guys saying, listen, Alex, I like industry XYZ. I don't know, fisheries in Norway, or I don't know, dairy in the Netherlands. I'm just using random examples. But the deals that we're doing are too big. And we're always doing all of this highly contested, auctions where the EBITDA is 50 million. And I want to do something that's much more proprietary. So if you have a unique insight on an industry, that could be one motivation. Another motivation is where you're really good at putting teams together, in which case you're a so-called independent sponsor. But you are not ready to raise a fund, or you don't want to raise a fund, right? But you say like, hey, I really can take the playbook from larger private equity funds and, as you say, assemble those products to actually sell to them. But I think we always start with the motivation, and there has to be a fit with your strategy. Again, in some cases, there are people that say, listen, I just love buying those traditional manufacturing companies, optimize them, not integrate them, recycle cash flows into buying more companies. Okay, that to me sounds like you're a holdco founder. And then, you should really go and build a holdco.
Yeah, it comes back to what you started with, like try to know yourself and like find a project that excites you for many years, which I think you finally found at 40.
Yeah.
Do you want to kind of like talk about the steps of like this ideal profile that would come into the bootcamp, and what would be the like step one, the thesis, and then like the sourcing, or no?
Yeah, absolutely. Yeah. So the bootcamp is meant to nudge you. So if you're just hesitating about whether to do this or not full time, bootcamp is not the right fit for you. For that, you'll have the self-service course, and of course, you can always read the newsletter and come to conferences. Bootcamp is great for somebody who has a thesis, even at a high level, but maybe you're an operations guy and you don't have like an M&A person, or maybe you're an M&A person and you don't have like an operations guy. So bootcamp is a great place for you to find a co-founder, find a thesis, and also select the best structure that you want. And I always like to start with the structure because it's the foundations, right? Okay. If the foundations are flawed, then the house, no matter how nice the house is, it was always going to be like flawed as well. And that's what I would start with, is like, okay, so ultimately, what do you want to get as an individual from this endeavor? And a lot of people start with the wrong motivations, where they come to me and say, Alex, I'm talking to this guys, they're offering me 20% equity and this guy's offering 30% equity. I was like, but this one is a 20 plus year project and it's a holdco and it's a 10 million endowment. This other one is a quick 3 to 4 year exit and they're offering you 25 million. So what do you want? And to me, it's like, what's the absolute amount of euros that you want to lift out of this? No, seriously. Like, and it's almost like, I'm almost like a wealth manager. There's people, I want to discuss your liquidity needs. Do you want to buy a house? Do you want to buy a yacht? Do you want to buy a bunch of Ferraris? So we should talk about that. The second thing that, I had personal experience with that and a lot of boot campers as well. What is the degree of control that you want to have?
Yeah.
Because if you don't mind being focused on one industry, but being controlled by an investor, a private equity backed roll-up is perfect for you. Because this guy's very focused on an exit. You've got your industry. If you would rather do something where you have a lot more independence, you should consider the independent sponsor route or the search fund route as well. So, so a perfect boot camper would be somebody that really wants to do it, maybe has already left their job, obviously if they have saved some money, and has those types of questions that I just talked about, because we can help them answer. If your question is, I don't know if I should do this or not, very simple. Come to one of our conference. I'm going to convince you.
Yeah, it's true. This degree of control, I think, is very important. When you come from, let's say, my background as an entrepreneur, you're always used to have on 100% of your company, but it's like a smaller business.
Yeah.
And then you're going to be, okay, I'm going to do this way bigger project, but I will be more, not like an employee, but like partner with a fund. And so it's true that if you come from a big finance background, you're used to have 0 shares. And now someone will give me like 10, 20%. It seems like a big upgrade. Mm-hmm. So that's something I saw, like, are you coming from like the lower numbers and you have like less equity, or like from being just an employee without upside to be like, okay, now I will be my own boss. Mm-hmm. So let's say there's this person and they want to do a roll-up. They're following the accelerated roll-up strategy by some French people we're going to interview soon. What's the step one? Like the first step is, I guess, validate your thesis. How do you verify that the market is right? How do you check this first step?
Yeah, it's a very good question. That's why we have investors in a bootcamp that have a lot of experience with that. I would say that it really depends on whether. So, high level, there are 2 types of strategies. There's the holdco strategy, which doesn't require you to be geographically or industry focused. And the second one is a buy and build, also called as a roll-up, right? And the outcomes or the objectives in both cases are very different. In roll-up, you probably want to build this product that you can sell to private equity. And so you need to have sufficient number of targets, mm-hmm. sufficient level of EBITDA, and some sort of a value creation thesis to get the magic number where this thing really re-rates.
What are the magic numbers?
Anywhere from 10 million EBITDA, it starts to get interesting.
After you've
bought them, yeah.
And what's the time that more or less you need?
I would say it really depends on the investor that's backing you. But let's say anywhere from 3 to 5 years, people want to see the result. Actually, you raised a really good point, because a lot of these conversations around how much equity do I get to keep and when should I exit? People think there's some sort of a biblical numbers that, you open up the page 5 and it's there. It's not like that at all. So my number one advice is that when you talk to investors, find out what do they need to deliver, because they also raise capital from somebody, right? Mm-hmm. And this is where you need to talk to them. Okay, are you an evergreen investment firm? Are you a fund? If you're a fund, what's your defined life? What is your investment horizon? What did you promise to your limited partners, right? But I would say right now, if you're doing something that is quite trendy, such as AI-proof roll-up, anything that's technical services, anything from high single digit of EBITDA starts to attract private equity interest. If you're doing something more mainstream, that's business services, you probably want to be 15 to 20 million of EBITDA to generate sufficient multiple arbitrage.
Okay, and you want to ideally do this in 3 to 5 years?
Yeah.
What about target companies? So now let's say we've validated the market. You have enough targets. Yeah. If you do the roll-up, how many companies do you think you need in the market to make sure it's big enough to go talk to everyone? Is there also a magical number?
Yeah, you want to have a couple of hundred companies that are actionable in your market.
Okay.
So it's not a desktop analysis, and that's the hard part. You basically need to have validated that these companies are good and they are for sale, and they are for sale to you.
So isn't anyone for sale at the right price?
Yeah, no, it's a good question. I think this is the chicken and egg problem. Is a lot of people get really nervous about going out there and soliciting, people's interest, talking to owners without having the capital.
Correct.
I would say, but that's a confidence game. If you're able to talk these people into selling to you with no money, and I shouldn't be saying this, but that's the reality. If you're good in convincing these people to sell to you when you don't have any money, imagine how good you're going to be when you do have the money behind you.
So it's, as you say, it's kind of a chicken and egg problem. And in the end, the job you're describing is kind of a salesperson skills.
Salesperson. This is still probably the single most important takeaway from the practical side of it is a lot of people are very good at selling to investors. They want to go on the call, it's Stanford MBA, they have a CFA, blah, blah, blah. And then you're facing a plumbing business. Do you think the owner cares about that stuff? No. The same people need to be able to convince this business owner, and so the transaction should be a good moment for them, right? It's a good experience. So yes, there's an execution aspect which is very technical. You've got share purchase agreement, but fundamentally, you're selling yourself as the successor, as the l'héritier of that business, right?
Le repreneur.
Exactly, repreneur. And if you're not able to give them that experience, they're not going to sell to you.
And I think that's why it's so hard for me to understand, like, how do you convince them to sell the business but stay with you for 3 to 5 years? I remember the conference from Mourad. What's the name of Charles-Henri's partner, co-founder? Marwan. It was super exciting. It was like, no, like your job is to buy founders, not buy companies. You gotta like keep those guys. And I still don't really understand how you convince maybe like 10, 20, 30 people to be like, join my project, sell me your company, but stay with me and like keep running your company. Like how do you do this? Like what's the motivation for the seller?
Yeah, I think that particular question, hopefully we can have Builders Associate come on the pod and answer that. But I would say, look, every investor wants you to start with a platform acquisition because it reduces your cost, right? So if you look at how some of the most successful roll-ups have started, for example, Fena is a very successful testing and inspection holdco in the UK with now over 200 million of EBITDA. So their very first deal, essentially in aerospace testing and inspection business in the US, essentially the owners of that rolled over and helped kind of kickstart the journey. So in an ideal scenario, you find a business where the owner believes in a roll-up strategy, wants to continue running this, and they see tangible benefits from scale, but they also see value add from you as the person who put it all together.
Yeah, okay. So for them, it's not really an exit. It's like, okay, we're going to exit in 3 to 5 years, and you sell them growth, like 3 to 5 exciting years where the company is gonna change, and usually that's what they want, like the best for their company.
Yeah, so this is one argument. The second argument is you allow people to cash out, but you also let them swap their equity from something that's very liquid into something that's much more liquid and has tangible value. And the third argument is going to sound a bit weird, but we are social animals. And so if you're assembling a family of companies with founders like the one you pitch into, he's like, I get to hang out with really cool people, right? And there's a company in Norway called Snowball. It used to be called Hawk Infinity. It's a software holdco. That's literally a core pillar of their thesis, where the founders are excited to be on the cap table with other founders.
Becomes a mastermind. Yeah.
Becomes a mastermind, yeah.
It's lonely at the top.
It's kind of like the Hampton of Europe, right? You basically have a financial instrument and like a social club all in one.
Yeah, I agree. That's why a lot of CEOs pay coaching and masterminds and go to bootcamps. So that's also a good argument. What is the ideal target for those first for this platform and for the add-ups? Since you said, of course, the opportunity is like to go lower than what private equity would do, because what's the ideal size? Because also you don't want to maybe competing with all this crazy new wave of not solopreneurs, but like people who are just buying one company. Do you have also a key number about the perfect size? What is too small? What is too big?
As many investors, as many opinions. But many search funds target companies in the 2 to 5 million EBITDA range, which is good because it's usually a business that's been running, has sufficient scale. That's also a really good scale for an initial platform. Obviously, if you can buy a bigger platform with more EBITDA, that's great, but then it becomes like a competitive tension.
Okay.
I'll tell you what you probably don't want to do. Because, in terms of like what does good look like, people have different ideas. What you don't want to do is start out with a bunch of really small companies that you bought them. And a lot of bad companies look bad from the outside. And a lot of people coming from finance in particular think that they are bad because people running them are bad. No, some industries are just really bad to begin with, and no roll-up magic will help them. Okay. So what you don't want is to buy a bunch of 500,000 EBITDA businesses, and then halfway through you start putting some central services and ERP system, and that just adds, a whole bunch of central cost drag, and this company is small, right? You basically want to have on day one your operating team identified. And you also want to have sufficient amount of headroom what you're going to do. Because if your whole thesis is based on cross-sell, which I've seen in a lot of software roll-ups, cross-sell almost never works.
Okay.
All right, cross-sell is very difficult. Cost synergies and being able to replace something with a central team, again, you have to be very smart. Because something that we discovered at Threecolts, much to my surprise, is that we'd buy businesses with receivables. And the idea was that we're going to have a central team chasing receivables. But the truth is, if you bought companies and the founders are no longer there, and let's say we had a business where people owed us $10,000, $20,000, $50,000, and these people were from a particular ethnic community, and they see there's a new owner, the old guy's gone, they're like, I don't know you, I owe you $50,000, I don't think so, bye now, right? So but also you don't necessarily want to take away working capital management, which it is responsibility from the local business. So you probably want to strike out a balance between you buying companies that are not too big but not too small, but also don't think that essential cost or some sort of AI prompt is the magic wand. It's not like that. You really need to understand the industry and what drives volume.
So not too small, not too big. Don't think you're gonna be like way smarter than the guys that did it before. And maybe if it's a bad business, if it looks like a bad business, it might be because it's a bad business, and you're not gonna just like change it magically. And if you basically, so also size is not the answer. Don't buy 10 small bad business. It won't magically become a big good business. Basically,
I'll give you like a pro tip. What does a perfect deal look like? And then hopefully our listeners will go and buy those businesses.
Yeah, I'm buying it right now.
I think a perfect deal, and I know two guys that did it in Europe, and they're going to make a killing on their deals, is where you find a business owner who's a authority figure in their industry, who've been doing this for a long time, and whose dream is to go big. But organically, they could never do this because, maybe it's an enterprise industry where new sales are very difficult. The clients are sticky. So for them, the only way to grow is through acquisitions. These people know who to buy. They know where the corpses are buried, so they will never go buy in bad businesses. So they want to go and do it, but they lack something, usually capital and ability to buy those businesses and integrate those businesses. So if you bring those two things, they will respect you. And I know, a friend of mine did a 4-way merger in Italy where they bought, 4 very niche businesses and created a sort of a 5 million EBITDA roll up on day one. And I know somebody in the IT services.
They're like all competitors?
Yeah.
Okay.
Yeah. And this is not something you can do for cold outreach or like AI prompts. You got to go out there. But basically, the moment you can convince the founder that, you're the person to do it with, because then, they will stay for 2, 3, 5 years. They will roll over their stake, which is why every conversation with an eligible founder needs to start with, what is your dream? If the dream is to retire and go chill, in Côte d'Azur or somewhere else, that's cool. Right? So maybe they're emotionally ready. If their dream is to go bigger, but they just don't have the resources, okay, can I be the person that's gonna help you?
Yeah, it's really a partnership. And in that case, I understand what we were like. It answers the question from before, like, what is their motivation? Well, start with asking, what is your dream? What is your motivation? And you're not buying their company. You're like giving them the solution to this dream of like going big, and they didn't have maybe the skills or the resources. So it's exciting. And if you find this perfect platform company and you are talking to some funds to finance you, but of course you are in between chicken and egg.
Yeah. How
do you get the money? What's the typical deal? How do you raise the money? And what's the typical structure with fund, bank, other loans? How does it work usually?
Okay, really technical question.
Yeah, I mean, maybe the answer is like, it depends.
You have to join the bootcamp to give all the answers. No, but I'll give you the high level answer.
Yeah.
I think one common question we get in the bootcamp and outside of the bootcamp is, when's a good time to talk to the investors? Is it when I have a platform, but then we run into the chicken and egg problem? I'll say, look, if you have eligible background, which is you have transactional background, or you've built something, an organization, you've scaled something, and you're serious about it, talk to them now. Because people are willing to put in the time, and there's no expectation that every idea that you bring is a great one. Maybe your first idea isn't great, but as long as you show to the investors the goodwill, you show your thinking, you learn about this, right? You tell them, hey, I want to roll up poultry farms in Bulgaria. Okay, and people don't like your idea, but they really like your thinking. Maybe the next thing you do is, I don't know, poultry farm equipment. And I know somebody in Spain whose first investment was literally poultry farm manufacturing business. The second investment was a fire safety roll-up, right? So figure out the right structure for you, go and meet the right investors, and find out their structures, right? So that way you have the name out.
Yeah, and step 0 is know that those people even exist. I didn't know before, seeing I'm reading the newsletter, but maybe I would see, sponsored by Strava. I was like, I don't know what Strava is. And yeah, this industry exists, and it's also there are salespeople like us. They are looking for people, and you are a matchmaker, and you're also showing that this industry exists. As you said, we were talking about VC. It's obvious there are so many websites where you can just VC list and 200, but this is very new, and people don't even know that it's possible. That's their job. They're here to listen to you and tell you if your idea is good, and it's a casting.
Yeah. Well, first of all, big shout out to Strata, partner of RollUp Europe, amazing investor. Absolutely right. There's been an explosion in new investors, specifically back in that type of space that did not exist 3 years ago. That did not exist even 2 years ago. And some of that investment is just wealth that's been recycled from previous successful roll-ups. RCIP in Germany gave rise to a fund called Avon. Simago in France has given rise to Builders Associés and so on. I think step 2 would be to figure out how much capital do you need. Because oftentimes, if you have a high level of conviction and maybe you don't necessarily agree to investor terms, well, if you're so convinced, just go and buy that business, right? And this is where I encourage people to get really creative, because if you have 20 or 30 or 40 million, all of a sudden everything seems cheap. But what if you were looking at the super attractive 1 million EBITDA business? Okay, go talk to the founder. How much do you want? What's the rollover? What's the holdback? What's the a founder loan? If this is a really good business, why don't you talk to Sparkasse or Caisse d'Epargne? I had a case in the town where I live, suburb of Zurich. A guy bought a business that does alarm maintenance. The local bank, invested in finance almost 100%. Because it's an amazing business. As long as people have homes and people want to steal from those homes, there's going to be those burglar alarms, right? And so pretty quickly you'll realize that actually you don't need a lot of equity for that first acquisitions. Clearly, if you need to do a roll-up, you need more. But investors want to see scale, but they also want to see you being really equity efficient. So for me, step number 1 is you're selling yourself as a product. So many founders will say, hey, well, I'd like to take out a couple million to maybe buy a house or give some money to my kids. I do need all of the 5 or 10 or 20 million right away. Okay, great. If the bank that's been banking this company says, no, we don't want to finance this for me is a red flag. Because why wouldn't you finance this business if it's such a good business?
That's a good answer. You were talking about a good business, but it's also there's a good business at a good price. Do you have any insight or big picture numbers? What is a good price? What is a good multiple at this size of business? If you want to exit, after 3 or 5 years, at 5x. Yeah.
No, this is good. So I would start by what's a good risk-adjusted return. So large cap private equity, 2.5 times net return from an investment, is considered good. Lower mid-market, the deals are small, the risk is bigger, it's not enough. So people that allocate money to that, specifically talking about buy and builds, they will be expecting, 4 to 6 times net to them. which sounds like a lot, but there's also a lot of risk that these guys will take on. And so for me, the question would be, who would be the ultimate buyer? What's the multiple that these platforms go for, right? If it's something very hot and sexy, anything that's regulated, like testing, inspection, water treatment, anything that has this recurrent revenue, we're probably talking about mid to high teens multiple of EBITDA, if it's sizable enough, right? If it's more commodity like business services, fire safety, that's probably going to attract a lower multiple. So if you, forecasting like a crazy high multiple, I wouldn't do this. So you need to have that margin.
Okay, you start with the end.
I would start with the end, because you do need to tell people what you're going to make for them based on something that's realistic. Then you kind of work backwards and say, based on capital structure, what can I afford to pay? Step 2 would be to go sense check this in the market. A lot of people coming from private equity industry, they really are afraid of heavily competitive auctions, and they sometimes disrespect brokers. It's a big mistake. Broker is your friend. Oftentimes there is a broker, but there's only one buyer, you. Broker gets paid depending on the outcome. Not obviously there is a ratchet, but ultimately broker is your friend. Broker helps price discovery. So it helps for you to go strike up a partnership of brokers and say, hey, you worked on this last 5 deals. What did they go for? Why did they go for? Right? A market with no brokers, just proprietary, is very hard, because then people oftentimes have ridiculous expectations. They want 20 times profit, or they heard, or their son who went to INSEAD, pulled up some analysis and shows them. So start with the price discovery, right? But I mean, in general, if it's a business services business, which is a lot of our listeners are doing, an agency business, 3 to 5 times cash flow is a good multiple for an acquisition, because then it means that, you can put some debt on it and you don't have to put that much equity. And it also allows you margin of error if in case things go wrong.
So that's the magic of basically doing a roll-up. You buy different smaller companies at 5x, let's say, and you can exit at 10. How do you go from 5 to 10? What's the magic in between? How do you create value? What is the path in those 3 to 5 years?
Yeah, well, I think number one is that you create a business that can be transacted by private equity, right? So that's something that they can deploy capital in. So that's number one. And I think it's not only a function of scale and multiple arbitrage, but it's also a function, what is the product that they want to see? And in the bootcamp, something that Alex Preusner from NGC said that really stuck with me, he said, they bought a door installation business, which had no advisor, no sell-side advisor. And they repositioned this as a testing, inspection, and compliance business, and they used a proper advisor. So being able to take businesses and being able to reframe the narrative, that really elevates the multiple. And I think a very good example would be Quatra, the used cooking oil recycling company. And again, Quatra was a bit lucky, where they started out by just buying this, small recyclers. And obviously in the early days, it was the biodiesel producers, the road transport. And then the sustainable aviation fuel initiatives happened, and now everybody's scrambling for aviation fuel. But for me, a really interesting business model is where you take businesses that are not necessarily considered recurring, and you turn them into utility-like assets. I'll give you one example. In the UK, Water Direct. Water Direct, one of the best search fund deals in Europe, where a search funder, Adam Johnson, bought a business that was emergency water provider to UK utilities. So every time there's a leak, and legally as a utility, you're supposed to provide 10 liters per person per day, these guys would rock up with their water tankers and disperse the water to the inhabitants. And the business model was reactive. There's a leak somewhere, okay, they have some water they have to take, and it was very annoying for the company. And then the Water Direct guys had this idea, but what if we made it like almost a subscription business where
like
people
insurance.
pay? Yeah. And same with HomeServe in the UK, right? Where the way you create this consistency in earnings and create this mission critical business is you offer just a better experience. So Same goes with Quatra. Quatra is nowadays viewed as an essential infrastructure business, and is transacted not quite on infrastructure like multiples, but not far. So I would say look for businesses that look like simple and interesting businesses, but is there like a regulatory aspect to them?
Yeah, it seems like the regulatory part is where a lot of interesting projects can be created. Speaking of this, the same question of like growing the multiple, like how do you make a difference between someone who's just like putting a lot of assets together, and when you look inside, it's just like different assets that have nothing to do, versus a real consolidation?
It's a tough question because there's a lot of holdco purists that will be watching this podcast.
Okay, so if you do a holdco, correct, you can do. You don't need to have synergies.
Yeah, so the holdco idea is that there are businesses that can work on a standalone basis, but there are some shared practices around go-to-market, pricing, working capital,
okay,
and also like very rigorous management of capital.
A high-level type of synergies.
Exactly. I think in general, the tolerance for unintegrated roll-ups is pretty low, where investors just not interested. If you assembled a bunch of businesses that are roughly similar, but there's no reason for them to be together, is not interesting. So I think step number one is that what tangible value can I add? And I'll give you one example. Anything that's route based, how can you increase the number of technician visits per day by improving route density? And sometimes this is done by, hey, there are 3 different fire safety companies that operate in this area. You roll them up, you raise prices because the clients have nowhere to go, and at the end of the day, they don't really care. But you also offer them like a much better service. That's one thing. The second thing I think is maybe getting your workforce in more of a service-based mentality, right? Where like, okay, technician visits because something broke down, like a sprinkler, but he's like, oh, when does the fire extinguisher expire? Or have you thought about that? It's where you reward people for giving your customers a better service.
Yeah, so I think it comes back to start with defining your thesis. Do you want to do a holdco? And you don't need to think about those things. It's just like buy good companies that you like and do a high level integration. Or if you want to do a real build up, make sure if it's just not a patchwork of companies that shouldn't be together.
Correct.
Amazing. Alex, do you want to finish with some announcements, some reminder of next events?
Absolutely. Well, I would say now is the time to go and buy your business and to achieve freedom. I achieved freedom and much higher life satisfaction for that. I've got readers and listeners like yourself now in a bootcamp. If you are intrigued by this idea, just start showing up at our events. You don't need to have anything. And for me personally, I'm excited for what's going to happen. We are going to host a big conference in London on the 24th of September, double conference. There's so much interest in technical services, HVAC. We're going to do a whole conference, and then in the afternoon, we'll have our flagship conference. We're also going to do an event in Paris later this year for the first time. I can't believe it's taken us, 3.5 years to come here.
It's happening.
In due course, we're going to come to Poland in October. So if you are a CEE-based founder, you should join us there. And in general, look, if you have an idea, just reach out to me. And the email is alex@rollupeurope.com. And look, ETA is freedom.
Thank you, man.
Simple as that.
It was amazing to have you.
Yeah. Thanks, Théau. Oh. Yeah.